Okay, so you know the importance of investing, but do you know how all of your investment accounts are taxed? I recently received this comment on YouTube from Colleen Beatty that says, can you do another video discussing how taxes work with investing? I think the uncertainty about how that works has kept me from doing anything beyond my 401k. Now, if you resonate with this comment, stick around. I have partnered with the experts over at moneyunder30.com to explain how taxes work with investing and what you can do to make sure that you are in a place where your investments just feel good. Hey, what's up guys? It's Justine with Debt Free Millennials, the channel to help you crush your debt and live payment free. Okay, so I was scrolling through this article from moneyunder30.com that talks about different ways that you can use in your investing strategies to reduce your taxes. But it got me thinking, okay, how are the investments taxed? And to Colleen's point, sometimes it's a little bit confusing to understand that. So let's start with the account that I think most of us have, which is a 401k. So contributions into a 401k are made with pre-tax dollars. So that means if you're a W-2 income worker, then you are typically setting that up with HR. That money is being pulled out of your paycheck first before it is taxed. Now, when you go to withdraw that money during retirement, that money is taxed. The money that you withdraw from your 401k is taxed at that time. And then that money is taxed as ordinary income according to your tax bracket rate. Now, a traditional IRA is taxed pretty much in the same way that a 401k is. So you're going to contribute to a traditional IRA up to $6,000 per year with pre-tax dollars. And then when you withdraw that money from that account during retirement, then you'll be taxed as ordinary income according to your tax bracket rate. Okay, then on the opposite side are Roth IRAs. Roth IRAs are like one of my favorite ways to invest into your retirement because contributions into a Roth IRA are made with after-tax dollars. That means you've already paid taxes on the money up front. So when you go to withdraw that money during retirement, that money that you withdraw is tax-free. Also, the investment grows tax-free. So it's got a great tax advantage if you use a Roth IRA and if you're eligible for one. There are contribution limits that you'll want to make note of for married couples filing jointly. That is up to $206,000 of your adjusted gross income, or if you're a single income earner, up to $139,000 is the income threshold in order to be eligible for a Roth IRA. Next, let's talk about just ordinary brokerage accounts. So a brokerage account has a lot more flexibility in terms of when you can withdraw the money. So it's not specifically an account set up for retirement. You could use a brokerage account for a variety of things. I actually use a brokerage account to save for a couple of things like a down payment, and I knew it was going to take me a couple of years to do so. So I invested in some bond index funds using a brokerage account. So it has flexibility because I can withdraw the money at any time, but you'll want to take note of how long that money has been sitting in there, because when you withdraw that money either underneath a year or over a year, you're going to be dealing with long-term or short-term capital gains tax. So these are taxable accounts. So let's cover the difference between long-term and short-term. So long-term capital gains tax happens when you hold your investments at least for a year or more, and then when you go to withdraw that money, you'll be taxed as long-term capital gains tax. With this type of tax, you will be taxed at your tax bracket, and you could pay anywhere between 0 to 20% on this money. If you're looking to withdraw money from a brokerage account in which you've held your investments for less than a year, then you'll be dealing with short-term capital gains tax. So if you've held your investments for less than a year, then you'll be taxed as ordinary income on that money. Also, another note about dividends, which are a company's distribution on earnings to its shareholders. You may have some tax liability on those dividends even if you did didn't sell anything to trigger capital gains. That's something to pay attention to when you're investing in a brokerage account that doesn't have any retirement stipulations associated with it. Okay, so we've covered 401ks, traditional IRAs, Roth IRAs, brokerage accounts. What about investing apps like Robinhood or Webull? Don't forget that investing apps like Robinhood and Webull, they are also taxed. Just like when you sell assets like stocks and bonds inside of a brokerage account, if you do the same thing with an investing app, you are subject to capital gains tax in this scenario as well. Now, typically, these investing apps will have a tax form for you to include inside of your tax return, so you want to make sure those are included so that you are properly reporting your gains inside of these investing apps. So no matter if you have one or multiple types of these investing accounts, Uncle Sam is going to want his fair share of taxes paid on your investments. So if you want to be smart about this and know that there are ways to reduce the amount of taxes that you pay, be sure to check out this article from moneyunder30.com on how smart investing could significantly lower your taxes. There's really simple strategies inside of this article that you can take advantage of, and now you have the knowledge to go forth, know that your tax situation is handled, and that you're making the most of your investments. Comment below which investment account do you have, and which one are you thinking about tapping into now that you know how they are taxed. If you like this video, make sure to give it a big thumbs up, and I will catch you in the next one.